Stocks have seen a broad-based rally with heavyweights leading the charge after the US Federal Reserve holds on to its interest rate outlook. IT and auto are the big gainers, while industrials and power are the big drags.
The Vedanta Group will trim $3.5 billion of promoter entities debt by FY27, says Group Chairman Anil Agarwal, adding that he will sell the non-core steel business if it fetches the right price, even as he is upbeat on the aluminum and zinc verticals despite the possibility of US tariffs.
After Aditya Birla Group's Hindalco, now Adani Enterprises has ventured into the cables and wires business with a joint venture. Analysts see the entry of big guns impacting growth and profitability of the incumbent stock down up to 15%.
The Ministry of Heavy Industries has asked Ola Electric to explain the mismatch in the sales numbers reported by it for PLI benefits and those reflected in the vehicle registrations data. The RTO Mumbai has also carried out inspections in its showrooms.
And the Indian rupee rallies for the sixth day in a row, gaining over 1% in the past week and 2% from its all-time lows as a likely current account surplus this quarter, and slowing FPI outflows turns the sentiment on the currency.
It's a strong session of trade which continues with a rally accelerating on the Nifty as well as the Sensex. I'm Mangalam Malu, with me Hormas Vatakia. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. Looking good for the market, 160 points higher on the Nifty, and this despite lesser contribution coming in from the Nifty Bank this time around, the index which is atop your head, Hormaz. And that's because, the outperformance today is led by the IT pack, which had been earlier underperforming. Maybe better prospects coming in from the globe in terms of no change from the Fed has supported the cause of the IT index after the underperformance that we've seen. No incremental fears, so to say.
Indeed, and looking good, right? There was some bit of a hiccup in the first half an hour of trade, but then it's been all hunky-dory for the markets. The dip that came in, that marginal dip, was very quickly brought into for the index. 160 points higher on the Nifty, now 23,070, and that means there are 1,100 points now from the lows that we made on the 4th of this month. So in 11 trading sessions, the index is up 11 points. And of course, the stocks that are doing well for themselves in today's session, yet again, Shipping Corporation of India was up almost 8 to 10% in yesterday's trade as well, up another 12% in today's session on the Nifty 500. That's the top gainer. The other one is KC International, that's locked in a 10% circuit. Some of the others that are doing well for themselves include the likes of Garden Reach Shipbuilders, building on to yesterday's 20% surge as well, with another 4.5% advance there, 5% higher now on Garden Reach. The other pocket that is doing well for itself today is the city gas space, and that is on the back of a fresh brokerage commentary that has come in, be it the likes of IGL, MGL. Sudarshan is joining in with more details on this. Sudarshan, good afternoon.
Good afternoon, Hormaz. So Axis Capital has today come out with a note, and on the back of that, you are seeing most of the city gas companies are trading higher. So it has initiated coverage on MGL with a buy call, and target here is 1580, and has upgraded IGL to buy, and target for the same is 224. But it has initiated coverage on Gujarat Gas with a reduced call, and target for the same is 390. Some of the catalysts as per Axis Capital: first, all these companies have been taking aggressive steps towards the expansion, and second, CNG economics continues to remain favorable if you compare with petrol and diesel. And third is addressable market size has increased to 55% of, if you look at the total volume of the PV industry, that is passenger vehicle industry, and government policy also remains supportive. So amongst all these three city gas companies, Axis Capital prefers those companies which have higher exposure to CNG, and those companies are largely MGL and IGL, and that's the reason they are bullish on those two.
Take that point, those stocks doing well. In fact, as we speak, a bunch of stocks doing extremely well, Sudarshan. If you look at Geo Financial Services, that has been an outperformer all through this week, continues to do well on that counter as well. The next Nifty entrant, that is. So Geo Financial Services comes up for you. Hindustan Copper has taken a leg up, and most of the gains have come by in just the last 15 minutes or so. Vertical up move is what we'll see. The intraday chart would so suggest on Hindustan Copper. And the other one which is actually seeing some traction is Pidilite. Pidilite has been, relatively muted over the last two trading sessions. Remember, the company held an analyst meet 2 days ago, and now perhaps, we are seeing some bit of pickup on that counter. So we'll watch out for all of this as well. But amidst the stocks which are doing well, there are a bunch which are not doing too well as well. And they primarily belong to the cables and wires sector on the back of possible rising competition, the entry of conglomerates. Vinny joins in with details. Vinny, we saw it first when Ultratech made its announcement, And now you have Adani's looking at the cables and wire space as well.
Absolutely. So now Adani is also looking at this cable and wire space. And now, right now, what they've done is they've just signed a JV. And they've formed a JV with Pranitha Ventures Private Limited. The JV is a 50-50 JV, which we'll call Pranitha Eco Cables Limited. This is with the 100% subsidiary of Adani Enterprises, Kutch Copper Limited. Now, when you're looking at it, what they've highlighted so far is that they will be engaging in the business of manufacturing, marketing, distribution, buying and selling of metal products, cables, as well as wires. So that is the latest update that we have. We do not have any amount of, the expenditure that they'll be making or the investment that they will be making in this front as of now for Adani Enterprises. But like you mentioned, we've seen that increase coming in terms of competition. And Ultratech Cement just last month had announced about their foray into cables and wires. They've announced a capex of around 1,800 crores over the next 2 years. So yes, because of this, we've seen all these stocks in the last 1 month have seen a significant fall coming in. KEI down 17%, Polycab down almost 10-11% in the last 1 month, and we have to factor in today's fall as well. That is also seen a sharp fall. Plus Finolex Cables, RR Kabel, all of them seeing a sharp fall in this last 1 month. What analysts are saying that obviously there is one more entrant coming in, so some bit of a competition increasing, and that is causing that jitteriness for all these other cables and wires, and a possible impact on the EBITDA front as well as the return ratios for these incumbent cable wires companies is something that analysts are watching out for. The clarity in terms of the amount of investment that Adani Enterprises will be making and what sort of a business that they're looking from this cables and wires foray is something that we still have to wait out for, but some bit of a pressure on the back of increased competition.
It's almost deja vu, right, for all of these companies just in a matter of a few weeks. Now Ultratech earlier and now Adani, most of these stocks taking a bit of a battering in today's trade.
You say deja vu, and as entrants enter, the investors will be like, deja who? Who else is coming in? There is Ultratech, there is Adani's. Similarly, in the paint sector as well, you had Birla's announce the foray, and then thereafter you had a bunch of other companies looking at entering paints as well. Pidilite, we just spoke about, they have a paints business called Haisha, and at the same time you have AkzoNobel, which is on the block. So who is going to buy them? So from deja vu, we'll go to deja vu.
Oh, indeed. It is deja vu and deja vu, right? For the investors, of course, it's not a pretty picture when it comes to this rising competition and the resultant impact on the stock prices. In fact, earlier today, we had a conversation with DSP Mutual Fund's head of equities, Vineet Sambre, who drew a parallel between the paint segment and the cables and wire segment, as Mangalam was just alluding to, with the new entrants entering the sector.
When we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment, and only after 1 or 2 years it really struck that it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks I think corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large.
All right, so the opportunity is going to be large. He says that maybe, perhaps, because of the price correction that we've seen at lower levels, there could be attractive opportunities as well. Because unlike the paint industry, in the cables and wire industry, the price damage has happened ahead of the market damage itself. So we'll keep an eye out on opportunities out here. Though, time for a short break. On the other side, we focus on the consumption space. Anuj Sethi, who is the senior director at CRISIL, joins in as they expect the FMCG sector to rebound in terms of growth by about 100 to 200 basis points. 6 to 8% growth in FY26 versus 5 to 6% that the companies are expected to post in FY25.
I thought, I should leave. I should go back to India. We will figure out what is it that we will do. There was no idea for free will. So I came. Rahul also left at the same time. Then we spent almost a month or two to figure out, okay, now what next? So it always started from the family, then solving some,
The
consumer
business plan-
problems.
The
or
business plan came later. First,
Always.
was about how do we ensure that we're in the
That
same.
has always been the priority. What you see in front of the label is very different than what is in the back of the label.
And then very different from what's actually inside the bottle.
Exactly. I guess so far we are in some 2,000 stores. In next 2 years, we can easily target anywhere between 15 to 20,000, right? When you go deeper into any category, you also understand the good, bad, ugly side of it. It's a misconception, to be honest. I think the percentage of spend required for R&D eventually is much lesser that you need for your marketing. Investing in R&D is much better ROI than always doing it in marketing.
$165 points on the Nifty. A lot of these FMCG stocks are actually doing well. So, not directly FMCG, but Titan, which comes under the consumption space, is doing well. It's been an underperformer, but, the stocks moved to the high point of trade. Higher gold prices typically do well for jewelry companies because people tend to prepone their purchases in anticipation of further hikes in gold prices itself. In fourth quarter, you typically have the wedding season and anticipation build up to Akshaya Tritiya as well. We do have Britannia, which has moved to the high point of trade, as have other FMCG consumption names which have moved higher too. So the FMCG index actually comes up for you on the screen. Speaking about the consumption space, in a recent note that has been released by CRISIL, they expect growth of the FMCG sector to rebound by almost 100 to 200 basis points versus FY25 and FY26. They expect 6 to 8% growth versus 5 to 6% growth in FY25 itself. So to discuss the rise of this and the retail sector in quick commerce in particular, Anuj Sethi, who's the Senior Director at CRISIL Ratings, joins in. Anuj, if you could give us a sense of what were the inputs that you, took note of before making this projection, and what is this based on? Is it just a lower base, or is it something incremental that is coming by for the sector as well? And the 6 to 8%, what would be the outperformers? Which, according to you, would be the categories that would grow upwards of 8%, and which would be the ones which would grow below 6%?
Yeah. Good afternoon, and thanks for having me. We expect the recovery will be driven by both urban demand as well as rural demand. And we know that rural demand has been outpacing urban demand, in the last 3 quarters or so. So the factors which will help some recovery in urban demand should be the moderating food inflation, easing interest rates, and also a series of measures which are announced in the union budget to encourage spending, and therefore we expect some benefit to come to urban demand. And rural demand should continue to grow steadily thanks to the allocation which is made for welfare schemes, expectations of a normal monsoon, and expectations that there'll be a reasonable hike in the minimum support prices of crops as well. Having said that, this year our expectation of 6 to 8% growth is based also that there will be some recovery in volumes. It will largely be volume led, about 4 to 6%, and the balance growth will come through realization improvement. Some players have taken some hikes to pass on the raw material inflation seen in certain categories, whether it is tea, coffee, copra, wheat, palm oil, and of late sugar and milk also prices have gone up. So our expectation is based on that. And the second part of your question as to which categories will do better than others, there are 3 categories, basically food and beverages, which is the largest, almost 50% of the market. And then we have personal care and home care, which is split almost equally, the balance 50%. Of these segments, we expect the food and beverages and personal care will be posing, mid-single digits growth, you can say, while the the home care segment, which did well last year as well, that should see higher margin closer to 10% in the road ahead.
Right. Anuj, good afternoon. Thank you for joining in. You mentioned that you're expecting this growth to be volume-led. Are you seeing something like that emerge on the ground, at least in the current quarter? What do you anticipate from these companies going into the fourth quarter as the results start trickling in anytime now?
Yeah, we expect some amount of volume recovery. It's already been seen in the rural side. While one more trend, what we have noticed is the larger packs are being less preferred, but the mid-size packs and the small packs, they are seeing quick pickup. And that has also been seeing the fact that quick commerce is growing pretty fast, and it caters largely to the mid and small size pack segment.
Right. Now, you know what's interesting is that you speak about some price increases coming in on the back of price hikes by the company. I would like to know your thoughts on whether there would be premiumization in this space as well. So if there was an element of mix change and that aids to the revenue, because that would then directly flow down to the operating profitability, which you expected to be flat, 20 to 21% after a 50 to 100 basis points decline in the last fiscal.
Yeah. So some amount of premiumization will happen in certain categories, say like in biscuits, also in personal care and home care. But that will be in very select categories. There again, we are seeing introduction of small packs, which is happening. As quick commerce is expected to grow pretty fast. It already grew at almost 30% last year. A similar sort of growth expected this year as well. So some amount of premiumization will help, but that's built into that 2% realization improvement, which I said.
So does this quick commerce going forward, expecting it to grow at a similar pace, but as competition intensifies within this, do you expect that growth to sustain? And does quick commerce then become the fulcrum of the entire sector when it comes to distribution and thereby ensuring growth?
See, ultimately, quick commerce companies also need to make money. So it will be a balanced sort of thing as they capture market share. Things will settle down, as we move along. But it doesn't take away the convenience, of ordering and having the goods delivered within a short time. So I think both models will coexist. The existing models will coexist along with quick commerce. But the focus will also be of some of the FMCG players to have a greater share of pie in the quick commerce trade as well.
What we're trying to understand from you is that, and this is something that we spoke with PwC this morning as well, where they said quick commerce is growing, but it's growing, it's not growing the pie as much. The pie is still likely to grow in 6 to 8% sort of levels as well, as per your expectations, closer to 10% for the retail industry, as per PwC's expectations. In that, quick commerce is likely to gain market share from traditional trade. So in that sense, is there a benefit of quick commerce for the sector on the whole, where it is not contributing as much to the growth, but it's just substituting one channel for the other?
That's true. It's substituting one channel for the other at the moment. But see, as of now, quick commerce is largely restricted to the metro cities, the urban areas. That's the reason why, it's not adding to the overall pie. But, it's more a convenience type of shopping, if you were to call it that.
But is there any, case for quick commerce to continue to grow at this pace even beyond tier 2? Because there are challenges, right? A lot of people who are in the quick commerce space say that tier 1 and metros are where they see maximum traction. Maybe the economies of scale may not be as favorable when they move beyond. So then the expectation of the consumption basket improving by virtue of quick commerce moving beyond metros stands questioned.
Yeah, it can be a more metro-centric sort of arrangement, if I have to call that. Whereas the traditional channels plus the other e-com channels, they are also spreading their baskets, wider into more pin codes, if I have to call them. In fact, e-commerce has a significant amount of penetration in pin codes, even more than a traditional model, I would say. So all models will coexist, but quick commerce is more going to be a metro-centric sort of model.
All right, final question before we let you go. Is there any particular specific trend that is calling out to you right now amidst all of that you're seeing? Any micro trend which you believe needs to be watched out for? And from a risk standpoint, what are the risks to your thesis of 6 to 8% growth?
Right. See, one more trend, what we have been observing is that the traditional FMCG companies are also looking at increasing adoption of digital channels, and they are targeting acquisition of D2C brands as well. Besides, of course, what I said, the trend of lower price packs to counter competition, which rose significantly in the last couple of years, especially in the rural side. There were a lot of regional brands which performed better. So I think that is one. Second, the risk to the forecast is obviously if we have a subpar monsoon, I think the rural demand, which accounts for about 42% of overall demand, I think that could take somewhat of hit. And then there could be down trading, again, going back to regional brands, etc. I think that's the largest risk we see.
All right, Anuj, thank you so much for sparing time, joining us with your outlook on the FMCG sector, and looking forward to having you more often on the platform. There was the interaction there with Crystal on the FMCG sector. We take a short break. We take the market at the highest point of the day now, the Nifty nearing 23,100. Somil Mehta of Mirae Asset Sharekhan joins in on the other side with a quick chart check and some trading strategies. Stay tuned.
Welcome back at the high point of trade, as we were expecting this morning itself for the momentum to accelerate, and the mid-cap index, which was underperforming by a bit, at the start of the show, has now also picked up pace. It's up around 2/3%, and this despite, the not so big contribution coming in from the Nifty Bank today. If you look at the key indices, we have the Nifty as well as the Nifty Bank in focus. What's contributing the most on the way up today is the IT index, which is up around 1.5%. There were, some issues with the mid-cap and the small-cap index which moved off highs. But through the day, we've seen more stocks advance than the number of stocks which have declined. So if you look at, the advance decline ratio, again, after a bit of volatility in the first half of trade, post 11, it has moved back to looking like a train track itself. And that's positive for the market. Both the Nifty as well as the Nifty Bank are now above their 50-day moving averages. The next key level to watch for the Nifty Bank would be above 50,000, which would be, the 100-day moving average. And the same for the Nifty is closer to 23,500. But that's far for now. Today, it's a Thursday. It is the weekly options expiry. So the strategy that we're talking about today, Hormaz, is called a strangle, where you sell a call and a put at different strike prices. The sale is taking place on the 23,000 put, with 18 rupees premium, telling you just below 23,000 is strong support coming in. But on the way up, the 23,100 call writers are fairly active as well for a premium of 18 rupees, telling you that if the Nifty goes beyond the 23,120 mark, there could be some bit of supply coming in. But the way the market is positioned right now, it seems like there may be a bit of a melt up beyond that range itself. Why do I say that? Because the Nifty, after this up move, is still at 2380, and we are seeing, in the money puts being written. 23,100 put has seen a bit of writing. So the street believes that the market would move much higher, and this in the money put would go out of money. And you've also seen some punt buying at the 23,250 call. 23,250 call is currently available for 1.85 rupees, 2 rupees. So people want to take that punt for the last 1 hour or so, whether the market moves higher. If it moves higher towards that, the 2 rupees becomes 3 or 4 rupees, them gaining a 33 to 50% in just, one trading session in a matter of couple of hours as well. But these are, remember, high risk punts that option buyers are taking. A lot of short positions added on names like KEI Industries and Havells. We've seen weakness in the cable space itself. Some long positions added on Bharat Forge, and we have Macrotech Developers as well, seeing some long positions being added. Just keeping an eye out on Manappuram and Polycab. Manappuram, we pointed out yesterday, may exit F&O ban that happened, and now today the chances are it may re-enter F&O ban. And with the kind of open interest that we've seen on the short side on Polycab, chances are this stock as well enters the F&O ban. So the cable space is in a bit of a worry spot, with Polycab likely to enter the F&O ban space.
Since you mentioned strangle, a pertinent question to ask is, are the bears getting strangled in this market right now?
If the Nifty sustains above this 23,100 mark for a bit, the call writers or the bears at that point in time may get strangled, may get squeezed.
We'll ask that question to Somil Mehta as well of Mirae Asset. Sher Khan is joining us. Somil, good afternoon. Thank you for joining in. 1100-point recovery now on the index in last 10 or 12 trading sessions. Do you expect some more consolidation here, or do you expect the index to move higher now to 23,500? And also couple that up with your stock recommendations as well.
The momentum is definitely very strong, and I'm not expecting any consolidation or maybe a intraday sideways movement, but not like a correction or anything. Nifty is trading about 20 and 40 daily moving average. The next target is 200 daily exponential moving average, which is around close to 23,400. So that's my target. Support would be 40 daily exponential moving average, which is 22,880. So that will be a very crucial support going forward in the very, very short term. And yes, I'm expecting the momentum to continue because FMCG, IT, and auto, all oversold sectors have started moving up. That's very good news at this point of time, because if Nifty has to move up 500 points from here, the oversold stocks has to move up. So yes, looks good. My stocks would be Asian Paints. That'll be my first pick. Stop loss would be 2240 and target would be 2450. My second pick would be from the IT space, mid cap IT, Bsoft, Birlasoft. Stop loss would be 395 and target would be 445. And my third pick would be SBI Cards. Stop loss would be 835 and target would be 890.
All right, Somil, thank you so much for sparing time, joining us with your views on the index and on specific stocks as well. Take a short break, more on the markets on the other side. Stay tuned. Welcome back. Nearing 23,100 now is the index, and it continues to build on to those gains, almost 200 points higher now on the Nifty. Some of the stocks that continue to do well include the likes of Fine Organics, that's up 5.5%. Capital market linked names like Kfin Technologies is up almost 6%. Bharat Forge has sprung up into the list of gainers, 4.5% higher on that stock as well. So Bharat Forge having a good day. At the highest point of the day now is the stock. Also doing well is GSPL, Gujarat State Petronet, is up 4.5% in today's session. Mangalam highlighted Titan at the start of the trading session, 3.75% higher there as well. Some of the stocks that are not doing so well though, other than the wires and cables companies, include the likes of CAMS. We had the management today on CNBC-TV18 where they spoke about the road ahead for the company, 3% down on that stock. Tanla Platforms, after a gravity-defying surge over the last few trading sessions, is down 2.5%, seeing some bit of profit booking. And Paytm, of course, down 4% after a sharp surge in a couple of days earlier as well. But Vedanta, that was the big interview that we had yesterday, where Chairman Anil Agarwal has promised to reduce debt by $3.5 billion by 2027. He also said that he's ready to exit the steel business provided he gets the right price. And he also said that the prices of aluminum and zinc are seeing premiums like never before. And he also vowed that professional management will run the companies after the proposed demerger comes through and not the family. That is an exclusive. Listen in.
75% of my personal wealth has been pledged for giving back. This company is not going to run by a family. This company is going to run by top professional, top mind for the country, on the having the best of governance. And we have to go through this because India has not seen this kind of ventures, this kind of development, and the trust is building. We have never seen premium on the aluminium what we see today. Highest premium in the zinc is the highest premium, or gas Can you believe that gas in India you can sell at $10? And same thing on the oil. So it is a time, it shows that how much is the consumption is increasing in India of this metal. If we get our price, we will definitely consider. But as it is, the company is doing extremely well and they are making cash profit. And we are very comfortable, but definitely I would like to put that effort to my other business. If we get a right price, we might sell. We have a full plan that we will be completely reducing our debt on the parent company in 3 to 4 years' time. This year, 25, we are going to reduce $1 billion debt. 26, we are going to reduce another $1 billion debt. And 27, we are going to reduce $1.5 billion debt. I have always said two things. In India, very, very important is drill, baby, drill, dig, baby, dig. That's what the whole world is saying. If you look at the President Trump, or you look at Trump, and I was the one last 25 years. 25 years consistently, I have not changed my business.
All right, interesting conversation out there with Anil Agarwal of Vedanta. He said, dig baby dig, much before drill baby drill from Donald Trump. But with that, we'll slip into a short break of the news that the market is doing extremely well. And we got some good news other than the market as well, which is the CNBC-TV18 app, which is live for all you viewers. It's India's business news leader, just a click away, which is this app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips itself. You can get this app from either the Apple Store or the Google Play Store. If not, then just scan this QR code, which is right on your screen.
Welcome back. Continuing our focus on stocks that are doing well today. One of them is Zee Entertainment, and that's on the back of a CLSA note. Vamakshi is here with more details on that. Vamakshi.
Well, Hormaz, CLSA has come out with a report on Zee. They have an outperformed rating, target price of 170 rupees per share, which implies a significant upside from the current levels. Keep in mind that the stock has slumped by almost 55% since its merger deal with Sony was called off. And with that, the valuations right now at 8 times PE are at the rock bottom for this counter. The CLSA is highlighting that they believe as ad revenue picks up, there is potential for the stock to re-rate. In fact, Zee is India's number 2 TV network and is also ramping up its OTT or Z5 business. The margins have already widened by around 9 percentage points from the lows, and the margins are now at 16%. CLSA believes that there is still room for margins to improve by nearly a further of 600 basis points to nearly 22% by FY27. Now, assuming an ad revenue growth of somewhere around 6%, they believe that the company could deliver 22 to 33% of EBITDA as well as PAT CAGR in FY26 to 27. As far as the valuations are concerned, Zee's market cap to sales is at 1 times, which is coming in at a nearly 60 to 80% discount as compared to the RIL Disney JV as well as Sun TV network. So therefore, when you look at the risk-reward ratio, that is highly favorable in favor of Zee Entertainment. It's a big upside that CLSA sees, and resultantly, the stock is up in trade.
Absolutely. And one of the very interesting points that CLSA also made is that they expect the stock to double over the next 12 to 24 months. So, Vamakshi, thanks a lot for that. Take a short break. On the other side, Manisha Gupta joins in with Siddhant Kamath, who is the director at Naturals Ice Creams. You would not want to miss out on that conversation. We'll be right back. Stay tuned.
Welcome back. And Natural's ice cream plans to debut on the quick commerce platform with certain flavors in the first phase. The company sticks to its no IPO stance. To discuss more about summer season outlook and expansion plans, we have with us Vedanta, director of the company. Vedanta, hi. Early and intense summer. It clearly is a good time to be in an ice cream business, would you say?
So, of course, for us, this financial year, we had a target of opening around 15 more stores, and we are on the right path. We opened our last store, 176 store in Kota. So we are on a runway to close at 180 stores by end of this financial year. So we are looking at year-on-year opening 15 to 20 stores, and we are growing roughly around 20 to 25%. So we are quite positive. With the new facility, with the new expansion of our manufacturing, we anticipate to take these numbers to the next level. Our target is to be 300 stores, double our store footprint in the next 3 years.
So 176 stores now, and nearly 180 is what you're targeting by the end of this financial year, and 300 stores in the next 3 years is the sense coming in. But Vedanta, also talk to us about the revenue growth that you're anticipating going forward from here.
So right now our gross retail sales is roughly around 600 crores. We are quite positive we will be 620 by the end of this financial year. Our manufacturing turnover will close at around 320 crores. So we are quite positive for the next financial year, because the season, of course, April, May, June contributes roughly about 40% of our top line. So we are anticipating minimum 25 to 30% growth.
Are you also looking to add any more new flavors? What are your offerings this new summer season? And are you also looking at more distribution channels now, especially with the way people are ordering ice cream sitting at home?
Yeah, I mean, two new interesting flavors. Of course, we're known for our seasonal flavors, whether it is mango or we're going to see Kala Jamun also in season in the flag end of April. But what we are very excited is we're going to make a debut on quick commerce. So we're quite excited for that. We're going to be launching on Instamart and Blinkit. So that is something new in terms of sales channel. In terms of flavors, we are known for our seasonal flavors. So of course the focus will be on mango, Kala Jamun, lychee, the seasonal summer fruits. We are trying something new, tropical flavors as well. With the likes of pineapple, strawberry, guava. It's a fusion of all of these three fruits. So looking forward for an exceptional season. And pretty much excited for our quick commerce debut.
Right. So Vedanta, let's slightly talk more about that then. And when is this quick commerce debut taking place, and which flavors are you targeting, and what cities are you also looking at?
Yeah, of course, we'll not go with the entire SKU. But we are looking at our top bestsellers, the likes of coconut, roasted almond, chocolates, mango, of course. And we're going to debut in, let's say, in Delhi NCR is going to be our pilot store, followed by Bangalore and Mumbai. Primarily the metros we're going to target, and then we'll follow it up with tier 1, tier 2 cities as well.
As the season brings in, are you also planning to launch sugar-free, low-fat flavors this time?
Yeah, the R&D team has been working a lot. For us, we are natural. So, so when I say natural, it's made with 3 ingredients. That's milk, fruit, and sugar. We're not looking to changing our DNA or our core. But yes, we are looking at variants where probably we substitute the sugar with a natural, preservative or a natural sweetener. We have successfully launched in Mumbai, Pune, and Bangalore our no added sugar range, and we are looking to extend this range to other parts of the cities, because we are seeing huge demand, especially in tier 1, tier 2 cities as well, for these flavors. But yeah, the focus also is going to be on introducing sorbets and also introducing non-dairy ice cream, which is vegan also, as an alternative to our consumers.
All right, there's a lot of stuff coming in this summers then. Siddhant, I remember the last conversation I had with you and you had told me that you're not looking at an IPO. Is the stance the same? Is there a change in thinking within the family?
Yeah, I mean, we are a family business. I'm a second generation entrepreneur, and we don't live quarter to quarter. We are living family to family. So no plans for IPO right now. We have a very determined vision and strategy in place, and that is what we are working towards.
All right. Until the next time then, Siddhant. But it's interesting to understand that every time you see summer coming in, there is more national and definitely more regional players within the ice cream space. And in the last year or so, we've seen more international players come into the segment as well. How is competition treating you and what does it mean for growth?
I mean, competition is growing. That means the category is growing, and I'm very thrilled that as the competition grows, the ice cream industry is growing. And when the ice cream industry is growing, we are seeing huge consumption also. I mean, the credit also goes to e-commerce and quick commerce because it's making ice cream more accessible. And also post-COVID, what we've seen is that people are investing in refrigerators, better quality refrigerators, because they understand the value of stocking up. So we've seen a huge demand in consumption. And when there is growing competition and a lot of acquisition, IPO, also the private venture also getting active in this space is very encouraging because it's the ice cream category is winning here.
All right.
All right, Siddhant, thank you so much for sparing time.
Hormuz, I can tell you, as Siddhant said, there's mango, lychee, kala jamun, pineapple, sorbets, non-dairy, vegan ice creams, and of course, he talked about guava ice creams. So I think this summer
is spoiled for choice, I guess. You're spoiled for choice, and so are we. But we look forward to that. If only we had some on our desks right now, you'd be definitely having some. But with that, it's a wrap on this edition of Halftime Report from Manisha, me, Manglam, and the team that put this show together. Thank you so much for watching. Business Lunch takes you through the half hour for lunch.